Hello and welcome. You're tuned into the Small and Mid-Cap Show. I'm Hiral, Dadia, and with me is Hersh, Sayta. Hersh, a very good morning. Clearly, if you see from a market's perspective as well, it's very interesting to see the kind of volatility that we've already seen in the last couple of trading sessions. Yes, there is that little lack of confidence right now that the investors are having. We are below the 21,600 mark, pretty much on the borderline in today's day of trade, but trading in the negative. We've hit a low of around 21,519 in today's session and a high of 21,750. The gyrations have been pretty huge. In terms of stock-specific action, the ones which are putting pressure today, HDFC Bank is the top loser with cuts of around 2.5% coming in there. Coal India is down in trade. Britannia, ONGC, as well as a BPCL are trading under pressure. Moving on to the gainers, Cipla, 7 to 8% is the kind of up move, and this is post the earnings. Impact coming in on a Sun Pharma as well. Bharti Airtel, and this is on one of the subsidiaries which has filed the IPO papers. That stock is up in trade as well. Power Grid and ICICI Bank, which is reacting to numbers, 2.5–3% up move coming in there. If you see in terms of Bank Nifty, over 300 points is the kind of cuts that we are seeing as we speak right now, and we're trading below the 45,750 mark in terms of Bank Nifty. And overall, if you see the advanced decline ratio, absolutely skewed towards the declines. You just have a ICICI Bank and a Kotak Mahindra Bank which are trading in the positive, but IDFC First Bank, which is down over 5% in trade, again reacting to numbers as we speak. So that's the picture with regards to where benchmarks go. Harsh, very quickly, in terms of if you see broader markets, what's the painting looking like?
Well, clearly underperforming the benchmarks, Hiral, in trade today. It's a tough day of trade, especially within the broader market basket. And what we are seeing within the Nifty mid-cap especially is if we can pull up the likes of Policy Bazaar, Max Health, Petronet, LNG, all of which are gaining nearly 6%. I'll focus on the positives first off. And, within the basket of negatives, we're looking at the likes of a Z, no surprise there, down 15% now as we speak. We also have the likes of an Oberoi Realty after its numbers down 7.5%. RVNL also seeing a bit of a correction. They're 7.5% lower in trade today. Some of those railway stocks also in focus, but outside of that basket, I also want to highlight IDFC First, which is down 5+% as we speak. In terms of the smaller cap indices, again, I'll stick with the banks first off. You're looking at the likes of a Karur Vysya, which is up nearly 7% in trade. You have Aegis Chemicals, Medanta, which are both gaining anything between 3 to 5% odd. Among the losers, you have the likes of a RITES, HUDCO, again, an IDFC Limited within that small cap basket, taking around a 6% hit, a bit on the chin there in terms of IDFC on the back of those numbers. But let's quickly shift focus to Canfin Homes. That's one of the stocks which is in focus on the small and mid cap show here with us today. The stock is trading with cuts today. Housing finance companies' provisions were at around 30 odd crore rupees. You saw asset quality took a bit of a hit in Q3, whereas the outstanding loan book has gained roughly 13 odd%. It's now reached the 34,000 crore mark. We have with us Suresh Iyer, who's the MD and CEO at Canfin Homes. Good morning, sir. Welcome to NDTV Profit.
Morning. Yeah, good morning.
Right. So I just want to try and first off understand this 13% kind of growth. What can we expect on full year FY24, and what's the outlook for FY25 looking? We're very close now to the end of the year.
That's correct. For the current year, we would stick to this 13 to 14% because in the fourth quarter it can't move the needle too much. But we would be, looking at a 13 to 14% only. But going forward, next year we can definitely look at, upwards of 15% in terms of growth, AUM growth. That's the projection we have.
Right. Suresh, this is Hiral on this side. Now, one thing that I want to pick up with you is on the loan growth. In the second quarter, we did see a 16% growth coming in there. This time around, we are at 13%. Disbursements have fallen around 7% on a sequential basis. Taking this into consideration, how are you looking at the overall year? Because clearly, the last time when we spoke around as well, you were absolutely confident of maintaining or probably the growth momentum to be picking up, and that would cover the shortfall of the second quarter. But this time around, it's lower. So where is the miss?
No, actually, we had in the second quarter a mishap because of which we had to incorporate a lot of procedural changes and tightening of the processes. And we were expecting that all that will not take too much of an impact on the business. But clearly that was not the case. And October, where we implemented the central disbursements and central reconciliation and the processes, there we've had a bit of an impact. And even going into half of November, we had that impact. So basically, that has what has resulted in the Q3 performance not being up to the mark. But, now we are kind of back to the 700 crore average disbursement per month kind of a run rate. So in Q4, we can look at a 2,500 kind of disbursement in Q4.
Overall, you were eyeing disbursements worth 10,000 crores in FY24, out of which, almost 6,000 would come in the second half. Do you think we'll see a miss on that number?
Yeah, definitely we will not be able to touch 10,000 crore, but we are looking at somewhere in the range of about 8,700 to 9,000 crore in terms of the disbursement. Presently, we are around 5,800. So that's the number we are looking at for the end of the year.
Sure, understood. And, let me try and come on margins actually. Your margins have actually gone up by roughly 12 bips or thereabouts. How does the margin trajectory go from here? Because what we will see from the NBFC basket is a little bit of margin contraction, which was expected. Yours has actually expanded by 12 bips sequentially. So going forward, how should one look at it? We are going to be in a more benign rate environment, hopefully, in 2024. So how should margins evolve in that case?
First of all, let me explain why the margins have actually improved in this current quarter. In the beginning of the quarter, we had about 6,700 crores where one rate cut was yet to be passed on, because on the asset side, we have an annual reset clause. Whereas on the liability side, when the rates were going up, we had the full impact of the rate increase. But on the asset side, this was a little delayed and there was a lag effect. So, but now, in fact, in the end of the quarter, we have now the entire 6,700 crore, which has experienced that 35 bips increase, which is the reason why, our NIMs have improved. But now with the entire portfolio having already experienced, this is the kind of real estate level of spread and NIM that we are looking at. And having said that, we are also looking at slightly increasing our ticket size, which will require us to offer a slightly, attractive rate in the market. And this being the final quarter, we'll also be offering some discounts, which normally is the trend in the market. So because of that, our incremental spread will probably impact a little bit. So we can expect somewhere in the range of about 2.6% spread and 3.7, 3.8% NIM for this quarter. That is the fourth quarter end of it. Okay. And one thing which also will impact us is that, in the end of this third quarter, we had a ratings upgrade from ICRA. And from a AA plus, we have now become a AAA rated for our borrowing program. This will also help us in managing our spreads a little better in the Q4.
Okay, so Suresh, overall, I'm just looking at the other aspect when I'm looking at the margins as well. Now we have seen healthy. I mean, the medium-term demand you had said was healthy. The yields that were aided by the loan repricing, and that's what improved your margins in the second quarter pretty sharply. Now that we're not seeing 6,000 crores, how much of the portfolio is yet to be repriced? Because that was the number we were watching out for in the second quarter. And that was providing support to the lending yields as well. So how does that dynamics change?
So as I said, in this third quarter, the entire 6,700 crore has experienced the rate hike. And so now our entire book is on a even state where on the liability side, the entire impact has been already impacted. And on the asset side also, now the entire book we have repriced. So there is no further improvement likely from here because of a repricing. Now that this, as I said, is a steady state kind of a situation. So going forward, we can expect that in the near term, we will probably continue to have a 2.6% spread and a 3.7, 3.8% NIM.
Right, and where would credit cost trend now that now that Q2 is firmly behind you? You've got your processes back in check. Where should your credit cost be at on a steady state basis?
See, going forward, in the beginning of the year or so, we had indicated that we have this entire restructured book of 670 crores, which is likely to come out by November, and that has already happened. And as indicated or expected, about 15% of the book was we were expecting might flow into NPA, and compared to the 100 crore figure, we have reached about 96 crores. So that is very much in line. But having said that, going forward, there is no further portfolio which is likely to come out of restructuring. So we don't expect any further impact because of the restructured book. And in Q4, we probably might see about 20-30 crore reduction in our gross NPA. So end of the year, we might probably end somewhere between 75 to 80 bps. That is 0.75 to 0.80% in terms of our NPA ratio, gross NPA.
Okay. So that's with regards to where the asset quality goes. Now, in terms of the operational, that's the OPEX, that was expected to remain high. This is on the back of the IT transformation, right, plus the plans that you had with adding almost 15 to 20 branches every year as well. And that's the plan over the next 2 years. So if you have to talk about the CI ratio, at what levels are you expecting that to be now? And in the next couple of years, how do you see it improving?
See, in the next year, at least, we don't see it improving because the entire impact or cost impact of this IT transformation will come through in the next year. So next year, the cost to income ratio might slightly increase to around 18.5%, which we have been indicating. This year also, we were expecting it to start, but because of a slight, delay in the implementation program, this year we are not experiencing that cost. So this year, what we had indicated as 18% may not be 18%. We may have a probably lower cost to income ratio somewhere in the range of about 16% in the end of the year.
Okay. And with regards to the impact on the ROA and the ROE, how much will that be, and where do you expect that in the, if you have to look at FY 24-25?
See, this year we are likely to at least see a 2.1 kind of ROA, and 18% ROE is what we can look at, which is very much in line with what we've already seen in the end of the Q3. And next year also we would definitely, we are confident we should be able to maintain a 2.5 plus spread and a 3.5 plus NIM, which will therefore help us maintain a 2.1 ROA and a 17 plus ROE.
Right. And, under your leadership now, we have more stability with regard to leadership, hopefully going forward. Where do you see taking Canfin Homes, say, 3 or 5 years from now? Would you be looking to double in 3 years? How would the trajectory look like? And where would the ratios really stack up? Would you continue to maintain 2% plus ROA through your term, as well as keep cost to income in check around that 15% odd mark?
Traditionally also Canfin has always had the best in terms of the market kind of, credit cost ratios. The NPA ratios have always been among the lowest in the industry. And we have therefore also enjoyed the best borrowing costs. So keeping that in mind, maintaining a 2.5% spread in the business, we should be able to maintain a 2 plus ROA going forward also. And as regards the outlook for the next 3 to 5 years, definitely the intent is to double the book in the next 3 to 4 years. That's definitely there. So around 20% kind of a CAGR in the AUM growth is what we would like to target.
Right. So that's with regards to the trajectory that you're looking at from a longer term perspective. Thank you, Suresh, so much for speaking to us at NDTV Profit. So that's the management of Canfin Homes, clearly indicating the miss that we will see in terms of FY24, but the kind of trajectory that they have over the next 3 to 5 years. The stock has been trading under pressure, 2.5% cuts coming in there. But let's quickly slip into a short break. Up next, we will be speaking to IRDA's Chief Managing Director, Pradeep Kumar Das, on the back of its Q3 numbers. Please stay tuned. Welcome back. You're watching the Small and Mid-Cap Show. IREDA, that's IREDA's third quarter net profit zoomed 67%, whereas if you see in terms of the loan book, that has seen a good growth as well. Pradeep Kumar Das, CMD at IREDA, joins in. Pradeep, good morning and welcome to the show.
A very good morning, Hiral.
Pradeep, clearly if you see, from the way the stock has performed, good investor interest, numbers have been pretty strong as well. What has worked and what has not worked for you this time around?
If you see, I think everything has worked for us.
No, absolutely. Everything has worked for you. So going ahead, do you think this is the trajectory that you will be able to maintain for the coming years as well? And if so, what is that key milestone you're looking at the end of the third year from now?
See, if you go back, look back 3.5 years back, we wanted a hockey stick growth of approach, and which we have achieved in last 3 years. 3 years back, with a loan book size of 23,000, 24,000 crore, to now we have crossed 50,000 crore. And with a net worth of around 2,300 to now we have crossed 8,000. And with a NPA, gross NPA from double digit, now it has come down even less than 2. Net NPA has come down to 1.5 range. So, and apart from that, if you look at perhaps we are among the few entity who is giving quarter to quarter full audited result. That means not only the growth in business in all parameters, we are giving the best quality corporate governance also. So that is most important. And when an investor is investing in renewable space, they are not only investing in economic value addition, they are investing in sustainable environment addition. So therefore, there are two kind of value, and this sustainable environment, when I'm talking of value addition with respect to purification of the environment through development of renewable energy, that is not getting quantified. So that is giving the investor a different kind of satisfaction. And post our IPO, what we believe and feel that the retail investors, they are also getting quite keen interest in it. So en masse general awareness is improving. And yesterday, with Honorable Prime Minister's announcement post Pran Pratishtha Utsav of Ram Temple in Ayodhya for solarizing 1 lakh crores of rooftops. So that is again going to further sensitize and improvise the awareness level and the responsibility of every citizen to further improve the solarization and renewablization in the country.
Pradeep, I'll interrupt over here. Interesting point that you've picked up with regards to Honorable Prime Minister Narendra Modi's comment with regards to 1 crore solar roof panels. If you could help us understand very quickly in 30 seconds, how does it benefit a company like yours, and what's the kind of revenue or overall generation of revenue that you could see out of it? Because all the companies, with regards to solar energy are up in trade today.
So let me first touch upon that macro aspect. So this 1 crore rooftop solarization will enable a outlay of 1.25 lakhs to 1.5 lakh crores. And if you take out the support of Government of India through subsidy part of it, around 1 lakh crores of debt component is going to come there. And if you see, by and large, our entity being the largest and most experienced entity, and today having around 20% of the capacity, installed capacity in the country support. So we are envisaging around 25 to 30% space we will continue to retain. And we have already opened a dedicated division for addressing the business support for the retail space. Not only this rooftop solar, even Kusum scheme we have already started doing. Already 2 schemes were 2 sanctions we have done in Kusum. In the time to come, through this retail division, rooftop solar and Kusum, as well as other MSME and SME category of renewable energy requirements, financing, we are going to do that.
Sure. Hersh also joining in, sir. Just wanted to try and understand, out of your disbursement in Q3, is there a larger trend towards private versus public? Is there something of that sort playing out? And would the mix change substantially as you really scale on growth?
See, if you see, we are gradually our private sector space grows. And if you see, initially 5 years back, we had more than 95% books in private space. During COVID period, we had enough space and comfort to support the government sector. And by and large, the development happens in by the private sector developers. Government is facilitating or enabling, except for the central CPSEs and few state PSEs. They are taking up the renewable. Otherwise, the investment is happening from private sector. And if you see, from 77 to 79%, we have gone up now. And in the time to come, more and more investment is going to come from private sector. Our loan book is going to go up. When I said 5 years back, we had more than 90%, 95% of private space. And largely, since inception of the company to till date, the development in renewable happened in private sector only. And despite supporting and having a larger private sector loan book space, our cumulative write-up till December is 203 crore. And against a total cumulative disbursement of 1,11,000 crore. So that speaks about the ability or competence and capability of the company's due diligence process, review monitoring, and ensuring qualitative assets in place.
Right. Overall, if you see from a cost of funds perspective, where are you expecting that? Because clearly, the co-financing deals that you have, as well as the financial flexibility that you're working with, the anticipation is that the mobility of funds would be at competitive rates, right? So where would that stand at? And taking that into consideration, how are you seeing the net interest margins improve?
You have seen in this quarter already our NIM has slightly improved, as well as cost of borrowing. And in the time to come, we'll further work on improving those. That means reducing the cost of borrowing and improving the rate of net interest margin. See, as far as our interest to the developers or to the borrower is concerned, we are very sensitive and sensibly we are taking decision in that, because our utmost focus is supporting the development, rather fastest development. And that is what we have done so far. And we're focusing on quantum growth wherever the assets are de-risked largely, particularly in the vanilla solar wind hydro, the risk premium is not there. So therefore, we allow there a fair amount of lower interest, which the NIM is less, but vis-a-vis, in those projects, our provisioning requirement is pretty low. So at the end of the day, our bottom line gets improved. So in the time to come, we have a couple of plan in place. Already I had indicated during IPO. Now again, I can tell with respect to opening an office in Gift City, so that we can borrow in Forex and lend in Forex to our RE developers who is having export potential, as well as who are planning to set up overseas projects. And we have quite a few demands from them. And we are working in it, and Deepam and Niti Aayog has already given approval, their consent, and we are just waiting for the RBI's approval, NOC, and we have done our initial preparedness. The moment we get at the quickest possible time, we'll open the office there, and that will enable to save the hedging cost what we are incurring now, and substantial portion of the saving will be passed on to the sector. Our ultimate objective to develop the sector fastest. And definitely, since we are now listed, our investors' concern also we have to see. So for some amount of margin also will be returning with us there. That is one. Second, we have already requested to Government of India for 54EC allocation, as well as some tax-free bond, and to have a defined green taxonomy in place in the country.
Sure.
And these measures is going to enable us to further reduce our borrowing cost.
Fair point. Point taken. And sir, lastly, I just wanted to understand the granularity of your book. When you lend, how much of the book mix is corporate versus outside of corporate granular? And when you do lend, is there what's the kind of mix that there is in terms of your top 10 borrowers to your total loan book size, which is at currently 50,000 crores? So what do your top 10 borrowers contribute to that loan book, if you can give us that perspective?
It's approximately in the range of 17 to 20%. And if you see corporate borrowing, all our lending is to corporate only, either corporate or LLP. We do not have any other BA. So when I'm talking about this retail lending, what we are doing there, we have brought in small NBFC or microfinance companies, those who are having already fair amount of business and significant presence in that segment, in that particular locality. So we have already done a couple of tie-up and we are quite successful in that. In the time to come, when I'm talking of retail, we're not going to non-corporate. We'll be having a corporate kind of loan portfolio only. So retail segment, wherever, I think if I understand you correctly, if you are trying to know in the retail, it will be non-corporate. So certainly those will be through those small NBFC or BA, microfinance companies.
Got it. Got it. I think this gives us a little bit of clarification on that. Thank you so much, Pradeep, for joining us on the show and sharing the views. And this is an interesting
one thing I can,
yes.
Before I wind up, one thing I can assure you, we'll be now focusing again and again on best quality corporate governance and interest of our investors, along with the developers' interest.
Absolutely. And that's what the street is looking out for as well. So that's the management of IREDA clearly giving out their views and commentary in terms of going ahead. But very quickly, let's just pull up a Z Entertainment on the screens. 20% cut is what we're already seeing in terms of where the counter is concerned. So far, locked in lower circuit and lots brewing on that one. But completely out of time with that, it's a wrap on this edition of the Small and Mid Cap Show. Thank you from Hersh and myself. Lots more lined up on NDTV Profit. Please stay tuned.